If war is bad, then why did stocks go up? That is the question that confuses ordinary people every time markets do something that feels morally upside down. They look at a world that is clearly unstable. They see missiles, threats, shipping routes in danger, energy stress, frightened headlines, and real uncertainty spreading through the global system. Then they open their brokerage app and see green everywhere. The market rallies, the SP rips, the NASDAQ flies. Television starts calling it a relief rally. Commentators smile and say the market is celebrating peace. And that is where the misunderstanding begins, because the market was not celebrating peace. The market was clearing positioning, that is the mother line. What happened was not a clean vote of confidence in world stability. It was a mechanical chain reaction inside a market structure that no longer behaves the way most people still imagine it behaves. That distinction matters enormously. The old story the public still tells itself is simple. Good news comes out, prices rise. Bad news comes out, prices fall. Markets are just giant opinion polls where millions of rational participants digest reality and calmly revalue securities based on what the future probably looks like. That story was never fully true. Now it is dangerously incomplete. The market you think you are watching and the market that actually sets prices are no longer the same thing. And if you do not understand that, then you will keep misreading every violent move as a judgment on the headline itself, when in reality the headline is often only the spark that sets off an already unstable structure. That is what this source document is really about. On the surface, it asks the obvious question. Trump announces a ceasefire with Iran. The next day, the market explodes higher. The SP posts one of its strongest sessions in months. The NASDAQ surges, the Dow screams upward. A few weeks later, stocks are pressing record highs again, even though the ceasefire is visibly fraying in real time, and the underlying conflict is nowhere close to clean resolution. Most people were told to interpret this as a relief rally. I think that explanation is far too lazy. The real story is much more interesting and much more important. The market did not rise because the world got safe. It rose because too many people were positioned for disaster. Too much leverage was leaning the same way. And once the immediate tail risk looked even slightly less catastrophic, the modern market's internal machinery was forced to reverse itself all at once. That is a very different phenomenon. It tells you less about peace and much more about the structure of the financial system. Now let us go back to the beginning, because the setup matters more than the spark. The source text is right to insist on that by late February. The world had already shifted into a very dangerous place. Joint strikes on Iran, the Strait of Hormuz under pressure, energy fears rising, oil market analysts openly talking about the possibility of a genuine supply chain detonation, Wall Street getting progressively more nervous, the SP grinding lower week after week. Hedge funds selling aggressively, macro shorts building, leverage running hot, anxiety everywhere. That is not just a backdrop. That is dry tinder. This is the first mechanism I want you to understand. I call it preloaded fear. A market does not need good news to rally violently. It only needs too much fear already positioned in financial form. That distinction changes everything. Most people think bearishness is just an opinion. Sometimes it is. But in a leverage market, bearishness is often an actual position. It is not merely, I feel cautious. It is borrowed stock sold short. It is macro ETF exposure leaning down. It is options protection layered into dealer books. It is systematic strategies aligned in one direction. It is capital already arranged for stress. And once that arrangement gets too crowded, the market no longer needs wonderful news to rip higher. It only needs the worst outcome to become slightly less certain than the positioning had assumed. That is what happened here. The source document cites Goldman Sachs prime brokerage data showing hedge fund selling at the fastest pace in years, gross leverage near extraordinary levels, and macro short exposure at highly elevated readings. Good. That is exactly the kind of evidence that matters. It tells you not just how people felt, but how they were actually arranged. Feelings do not squeeze. Positions do. And once the market is full of positions leaning one way, the real question becomes very simple. What happens if the thing everyone feared most immediately becomes harder to justify at the same intensity? That is where the short squeeze begins. Now let us slow down and explain that, because this is where a lot of people still lose the plot. A short sale is not merely a negative view. It is borrowed stock sold into the market with the hope of buying it back later at a lower price. That can be intelligent. It can also become a trap, because if the stock rises instead of falls, the short seller is not just wrong, he is structurally wrong in a way that can force him to act. He has borrowed something that must be returned. If the price rises enough, the pain is no longer optional. At some point, the short must be covered, and when enough people must cover together, they become buyers. That is the second mechanism. I call it forced reversal. A short squeeze is one of the purest examples in finance of price creating its own next buyer. The short seller who helped push the market down becomes the same buyer who helps push it back up once the move turns against him. The public sees a rally and imagines optimism. Often what it is actually seeing is pain. The market rises, the losses on the short rise, the margin pressure rises, the broker tightens, and the short seller starts buying, not because he suddenly loves the world, but because he has no choice. That is why squeezes can be so violent. The buyer is not a believer. He is a prisoner. That is what makes the rally feel so detached from the headline explanation. The market was not suddenly full of people who thought all geopolitical risk had vanished. The market was full of people who had positioned hard for catastrophe and then found themselves being forced out of those positions when the catastrophe did not immediately intensify on schedule. That is the first domino, but it was not the last. The source document is absolutely right that after the short squeeze began, the next great buyer to arrive was not human conviction. It was the machine, specifically systematic strategies like CTAs, commodity trading advisors, trend-following funds, rule-based models, call them what you like. The point is the same. These are not people sitting around thinking deeply about whether peace in the Middle East is authentic. These are systems that respond to price behavior. When price trends down far enough, the model says short. When price crosses the right trigger levels back upward, the model says cover and then flip long. That is mechanical. And mechanics can be more powerful than narratives. This is the third mechanism. I call it trigger momentum. The public likes to imagine that prices move because investors became more optimistic about earnings, peace, or growth. Sometimes that happens, but in modern markets a huge amount of movement happens because price itself is the input. Once price crosses the line, the machine acts. It does not ask whether Trump's ceasefire post was credible. It does not ask whether tanker traffic has normalized. It does not ask whether the old geopolitical equilibrium really returned. It asks one thing only: did price move enough to change the signal? If yes, it buys. That is what makes this kind of rally so difficult for traditional investors to emotionally accept. It feels disconnected from reality, because in the short run, it often is disconnected from the kind of reality they are looking at. The machine is not studying diplomatic truth. It is studying statistical thresholds. And when enough systematic money flips together, the move becomes much larger than any ordinary headline reaction should have justified. The source text points to billions upon billions of notional exposure, having to move as these systems reversed. The exact figure matters less than the character of the move. It was enormous. That is what you should keep in your mind. Once the models flipped, the market no longer needed philosophical buyers. It had mechanical buyers. That is second domino. Then came the third, the options market. Now here is where modern markets become almost unrecognizable to people still operating with an older map. They think of options as some side casino sitting off to the corner, a place for aggressive traders to take tactical shots. That used to be a more tolerable simplification. It is no longer accurate. The options market now helps govern the behavior of the underlying market itself, because dealers on the other side of those contracts must hedge dynamically in real time. That is one of the most important changes in market structure over the last decade, and most people still have not emotionally caught up with it. This is the fourth mechanism. I call it dealer reflexivity. When customers pile into certain option exposures, the dealer does not simply absorb that risk and sit there. The dealer hedges. If calls dominate and the market rises, the dealer may have to buy the underlying stock or index to remain balanced. If puts dominate and the market falls, the dealer may have to sell. These hedging flows can amplify the original price move, not because anyone decided the fundamental value changed that much, but because the plumbing of the derivatives market demands action. That is what reflexivity means here. Price changes position, position changes hedging, hedging changes price again. That loop is what the public keeps mistaking for the market digesting the news. The market is often digesting itself. The source document references a negative gamma setup before the ceasefire announcement. Fine, the exact dealer books move by the second, but the principle is what matters. In a negative gamma regime, price rises can force more buying and price falls can force more selling. Stability weakens. Procyclicality takes over. That is why a squeeze can become a surge. It is not just shorts covering and CTAs flipping. It is dealers being pulled into the same direction. At the same time, three dominoes: shorts forced to buy, trend systems forced to buy, dealers forced to buy. That is not peace, that is structure. And once you understand that, the whole narrative handed to the public begins to look shallow. They were told that the market was celebrating a ceasefire, but the source document points out something crucial. The physical evidence of real normalization was weak. Shipping through Hormuz had not returned anything like ordinary baseline levels. The ceasefire itself was unstable. The underlying regional risks were still visible. So if the physical world had not yet really normalized, then what exactly was the market celebrating? Answer: it was not celebrating, it was unwinding. This is the fifth mechanism. I call it narrative cover. The media always needs a sentence. Markets do not. That is one of the deepest misunderstandings in finance. The public thinks the explanation comes first and the price follows. Often the price moves first because of positioning, leverage, and plumbing, and then the narrative arrives afterward to make everyone feel less uncomfortable about how strange the move actually was. Relief rally sounds respectable. A huge mechanical reversal caused by an overcrowded short book and machine-driven feedback loops sounds much more unsettling, so the simpler narrative wins. That does not make it true, it makes it more broadcastable. Now let us go one level deeper still, because this is where the source document becomes more than a one-event analysis. It starts turning into an argument about what the stock market has become, and I think that argument is very important. The old market was dominated much more heavily by humans making discretionary judgments about valuation, business quality, earnings trajectories, balance sheets, and what a company should actually be worth. That world has not disappeared entirely, but it is no longer the same market in terms of price-setting force. Today, passive funds hold huge shares of public equities. Rule-based giants move enormous size. Options flow distorts hedging behavior intraday. Same-day expiration trading creates massive gamma swings. Multi-strategy hedge funds run heavy leverage with risk limits that force fast selling and fast covering. In other words, the modern market is less a grand council of patient valuation and more a giant feedback system of flows reacting to other flows. That is a much more dangerous and much more interesting machine. This is the sixth mechanism. I call it the market of reactions. Most people still think the market's dominant players are deciding what things are worth. Increasingly, the dominant players are deciding how they must respond. Passive funds respond to index weight. Hedge funds respond to drawdown limits. CTAs respond to trend triggers. Dealers respond to option exposure. That means the price path itself can become more important in the short run than the underlying truth people assume the price must be reflecting. That does not mean fundamentals are dead forever. It means fundamentals can be overrun for long stretches by structure. This is why I tell people the market is not irrational. It is reflexive. A reflexive system does not need to be stupid to look absurd. It only needs enough internal actors reacting to each other at the same time. That is what happened on the rally the source document describes, and it is what has happened repeatedly in different forms over the past decade. One catalyst: too much leverage, too much one-way positioning, threshold breached, machines flip, dealers chase, passive money never really leaves, and suddenly a move that should have been a bounce becomes a vertical re-rating event. The source text points to prior episodes, and I think that is useful. December 2018, Powell's language shifts and price explodes. August 2024, the yen carry trade unwinds, the Nikkei collapses and rebounds. Different headline. Same deeper structure, mechanical flows stacked on top of one another. That is what people need to understand. The headline can change. The machine beneath it often stays the same. That is why the old sentence, "Markets hate uncertainty," is both true and useless. Of course, markets hate uncertainty, but modern markets do not express that hate in the old simple way. They express it through leverage, de-risking, crowded positioning, dealer hedging, passive absorption, and abrupt flow reversals. If you stop at the sentence and never study the structure, you end up sounding informed while understanding almost nothing important. That is not good enough anymore. Now let me tell you why this matters beyond one war rally. Because if the market is really this machine, driven, then investors need to completely rethink what headlines can and cannot tell them. A rally does not automatically mean the world improved. A sell-off does not automatically mean the economy truly broke. The magnitude of a move now often depends less on the news itself than on how the machine was arranged when the news arrived. That is the seventh mechanism. I call it positioning truth. There is an old saying in markets that price moves not on the news, but on the difference between the news and the positioning. I think that remains one of the most useful lines in finance. If everyone already expects disaster and disaster merely becomes somewhat less immediate, markets can rip. If everyone already expects calm and calm merely becomes slightly less certain, markets can drop hard. The event alone is never the whole story. The event meets a pre-existing structure of expectations, leverage, hedges, and exposures. That meeting is what creates the move. That is why this rally was so strong. The market was leaning one way. Then it had to violently unlean. That does not make the rally fake. It makes it structural. And a structural rally can still keep going longer than the headline rationalists think, because once the machine begins, people who missed it start chasing it. Systematic models add to it. Passive flows continue supporting the biggest names, and the whole thing can look like a genuine macro endorsement, even if the original spark had very little to do with the strength or durability of the underlying piece story. This is one reason the Magnificent Seven and other index heavy names remain so dangerous to read simplistically, because passive index construction itself keeps funneling more weight into the biggest winners, which means the stocks with the greatest market cap gravity often attract flows simply because they are already large. That creates another layer of self-reinforcement. The larger they get, the more passive money owns them. The more passive money owns them, the more stability or buying pressure they can display during broad flow events. The market stops being a neutral weighing machine and becomes, at least in part, a market cap amplifier. That is not healthy in the old sense, but it is very real. This is the eighth mechanism. I call it size magnetism. A great deal of modern equity demand is not asking what company deserves more capital today. It is simply following the existing size map. That means the winners of the old cycle are often handed structural support in the new cycle, even before fresh fundamental work is done. This is why index-heavy markets can look so disconnected from the economy ordinary people are living through. A handful of giant names absorb the flow. The index looks strong, and the public mistakes index strength for broad health. That is not the same thing. And if you understand that, you begin to see why a war scare, a ceasefire headline, and a massive short squeeze can all coexist with a market printing highs, even while the deeper geopolitical and inflationary risks remain unresolved. So what do I do with that understanding first? I stop romanticizing the headline. If markets go up after a ceasefire announcement, I do not immediately conclude the market has become wise about peace. I ask how crowded the short trade was. I ask where leverage sat. I ask how CTAs were positioned. I ask whether dealers were in negative or positive gamma. I ask whether the move is a message about the world or a message about the machine. That is a much better habit. Second, I stop expecting clean morality from prices. Markets are not moral reporters. They are systems of capital leverage, risk transfer, and forced response. A good person wants prices to move in a way that matches the emotional seriousness of war. The market wants to clear exposures. Those are not the same objective. Once you accept that, the emotional confusion gets much lower. You stop asking why the market seems heartless. The market was never trying to be compassionate in the first place. Third, I stop worshiping fundamentals on a one-week time horizon. This is very important. Fundamentals still matter. Over long periods, they matter immensely. But short-run market structure can overpower fundamentals with shocking force. That means the investor who wants to survive and allocate intelligently has to understand both layers, the business layer and the flow layer. Ignore fundamentals, and you become a tourist. Ignore structure, and you become a moral philosopher watching price. Do things you do not understand. Neither is enough. And finally, I become much more cautious whenever a market is heavily levered, passively dominated, options, saturated, and broadly positioned one way around a high volatility event. In those conditions, the biggest risk is often not the event itself. The biggest risk is the reaction loop that can follow once the first trigger hits. That reaction loop can make the market look stronger, weaker, wiser, or crazier than the underlying macro story really justifies. That is the world we live in now. So here is where I come down. War is still bad. Uncertainty is still bad. Oil shocks are still bad. Fragile ceasefires are still bad. But markets do not rise or fall in direct proportion to the moral weight of those truths. They rise and fall through a machine. That machine right now is dominated by passive flows, leveraged funds, Connecticut, trend systems, options dealers, and reflexive hedging behavior. On the 8th of April, that machine squeezed upward. Shorts had to cover, trend models had to reverse, dealers had to chase. The index, heavy structure, amplified the move, and then the media handed everyone a neat story about peace because the actual explanation was too structural, too mechanical, and too uncomfortable. That is what really happened, not a genuine celebration that the world got safe. A giant financial feedback loop repricing itself upward once the worst case path stopped looking quite so immediate. That is why stocks went up. And once you understand that, you stop being surprised when markets and headlines seem to live in different universes. They often do. Because the market is no longer just a scoreboard on the news. It is a machine reacting to itself. And the people who understand that machine will read these moves much better than the people still waiting for price to behave like a clean moral judgment on the world.